Guys, what's up, and thanks for checking into the channel. Oh man, you've been waiting for 100% financing and you're asking yourself, is that even available in this market? 2022 July, where the ceiling is falling down on us, inflation's going through the roof and rates are going up. Can you still do 100% financing? The answer is yes, my friend. We could do 100% financing. Let me walk you through it. So if you're trying to capture that information, get yourself a pen and paper, write down some notes. This is designed for the person who is running a business and now wants to buy an owner-user facility. Did you catch that? This is not for the person who's buying a residential home and trying to get or take advantage of 100% financing. You are a business owner. This is for a commercial loan, and now you want to buy a place to operate your business. I want to talk about a few things. There's a big difference between being owner-occupied in a business and investment property or commercial investment property. And that's really the first box that I want to check off. Because when you're approaching a transaction as an investor, there's very little vested interest in the real estate as it pertains to your business. And therefore, that's not something that you're going to be able to get 100% financing for. That's not the topic of this video. What we are actually focusing as you today are running a business with a facility. You're paying rent either for an office or for a warehouse. If you're running a corporation, it's the first page of your tax return. It would actually show the amount of rents that you write off, whether that's what you pay or not, every single year, and that would actually get replaced with the new mortgage. All right, so before we get started, please do me a big favor, hit the like button, subscribe, and notification bell, because it's the only way that we could tell the Google algorithm this content is relevant and I can make more of it for your benefit. Let's dive right in and get started. So the big difference between investment and owner-occupied real estate as it pertains to a commercial space is the fact that you are actually operating your day-to-day business out of this particular facility. So whether it's your office and you have employees and now instead of renting you buy your own location as an example, or whether it's a warehouse where you store all your stuff and you have a front office or not, but your day-to-day operations happens in this facility, this would be considered an owner-user location. And for that, we can max leverage, which is the amount of money that you can finance to actually try to get you 100% financing. How does this really work? Well, let's discuss that. You have two lanes when it comes down to getting finance as an owner-user. Now, there's differences on these two paths. And the big difference is when you actually walk into a bank and you request a loan, the bank is going to look 3 years back on your financials to see if your business cash flows. What does that mean? It means, is your business profitable? Not only is it profitable in the sense that it makes money every single month and every single year, but when they look at you as the owner of the business, and this is called a global approach, are you profitable? You know, when they run your credit and your personal liabilities, do you have more debt than income? And that's a key component, because remember, as a lender, you want to make sure that you're paid back. Very important. Now, what I want to discuss are options, because we're only as good as our options. So if you're walking into a bank facility, and that would be considered a conventional approach, okay, then you have two options. Typically, you have shorter term financing, which would be likely more favorable in terms of rates. But in commercial financing, typically you don't have that 30-year amortization like you have for residential real estate. So you're going to be somewhere between 20 and 25 years. As you drop the years, it means that you actually have to pay your loan in a shorter period of time, which means that your payment is actually higher. For that, you're going to actually get better terms. as the amortization schedule goes up to 25 years, your payment will go down. Likely the interest rate will go up a little bit, but not too much. For that, you're gonna probably have to come in with somewhere around 25 to 30%, because now you have a lender, which is a bank, who wants to earn your business relationship. What does that mean? So typically, a lender is looking at you as a package, not just a loan. This is why it's so important for the lender to earn the owner-user relationship, okay? Unlike the investment piece, which we're gonna talk about that next, you see, it's very valuable to the bank, who is the lender, to earn your business relationship, not just your loan. And that's why the lenders will ask for the relationship, not just for the loan, but for the relationship, because it's very beneficial and also profitable proposition for the lender to have your business banking with them. So they'll offer you the loan, and then in turn, there's gonna be other conditions. As an example, they will say, listen, if you're willing to transfer X amount of money to us for liquidity, we may give you a better rate. And the reason is, now you're giving the bank working capital so they can lend it out and make more money on it. You're also a possible candidate for a credit card. They make money on credit cards. And then what about your merchant services? Difference between credit card, you using credit card for your business, bank making money, and you accepting credit cards, merchant services, the bank is also making money. You accepting wires into your account. There's certain fees that are associated to your account. So you're actually becoming a package to the bank. So that's why an owner user is treated very, very differently than investment property. The lender typically is looking for somebody, like we discussed, who cash flows both on the business end and globally, which is, this may not be the only business you have. You might have other businesses. Imagine you're trying to get a loan for your business. I'm gonna, take this just a step further so you understand. Imagine all your businesses that you're running are kind of like different limbs of your body. So you have 2 arms, 2 legs, right? And your body. So if you don't cash flow enough in your one business to get a loan, the lender may request that other businesses, business, guarantee the loan as well as yourself. And you might ask yourself, why? Because you might have spread yourself among 5 or 4 businesses where there's different income coming in, and there's maybe not enough income coming in from here, but if you also use this LLC and this LLC, now you have more income coming in to guarantee this loan, make the lender feel more comfortable. That was the first bucket. I want to switch gears and talk about the second bucket. Oftentimes, when the business hasn't really had many years to get established, or maybe isn't as strong as it could be, maybe there was a swing like COVID, where businesses kind of took a bit of a hit and now they're coming back up. The key here is having 2 out of the 3 years cash flow. And hopefully the last 2 years, because like any lender, they want to see that the trend of income is going up and not down, right? Imagine you're lending money to somebody, you want to make sure they continue to make more money, not losing money in their business. Because if they're losing money, likely they're not going to be able to pay you over time. So what we're going to now is an approach called SBA, okay, Small Business Administration. It's sort of like Federal Housing Administration, FHA, when it comes down to residential real estate. If there is a problem, meaning that not enough liquidity, not enough cash flow, not enough time, maybe credit's not that great, maybe there's only 1 year of cash flow, and when I say cash flow, I mean recorded, means that you actually filed your tax return. Not that you say, hey, you know what, I had a horrible year last year, which was my first year in business, is now my second year, and here's my profit and loss. Everyone likes to see that you actually filed your taxes, because when you pay on your income, it means you actually made that income. Even if you made $1 million this year, but you haven't filed your taxes, by the end of the year, you could actually file 0 income, because you can offset it with your expenses, and then again, you don't have cash flow. So if you're having challenges, you take an SBA route, Small Business Administration. And now for that, you could actually go higher on the leverage, because before we were talking about lending you 70 to 75%. Now you can go 90 to 100%. This is the ticket if you have a business that, one, you want to have a higher loan amount, two, needs a little bit more assistance, three, hasn't been quite as established, four, doesn't really have all the cash flow in the world. It may be analyzed for an SBA loan. SBA has channels called CDC, all right, a Certified Development Company. There's about 250 of them nationwide. Why is this important? Because it's a middleman between the lender and between SBA. And the CDC is designed to stimulate the local economy because it's a nonprofit. So the lender typically, and now I'm going to give you this curveball. Remember I told you there's two options in SBA. There's something called a 504, which is where the CDC comes into play, and I'll explain to you why in a minute. And then there is the 7A. Now, in most cases, the CDC will work directly with the bank. Every bank will have a CDC that they typically have a relationship with. A 504, the reason is 50% of the money comes from the bank, and 40% of the money comes from the Certified Development Company, the CDC. Why do you care? Well, number one, it's two different loans. It's kind of like having a first loan on your house and a home equity line of credit. So they're two different programs, and the rates are different and the terms are different. Now, why is it beneficial to you? Because I'm going to put this in perspective. Say that you have a loan that you give in first position to anyone, and you only give them 50% of the value. How confident are you that they will pay you back? Super confident. 50%, I mean, even if they walk away from the deal, there's 50% equity in the deal. So the lender is only taking the first position at 50%, meaning the first mortgage, 50%, okay? The CDC is taking the second position, meaning that they're actually lending, let's say, call it 40%, 90% together in second position. So they're really taking the risk, the nonprofit. Everything they do has to tie to SBA guidelines, because at the end of it all, CDC needs to send a file to SBA to get stamped that this is approved for you. Two different loans, higher leverage, and you may get your loan stretched out to 25 to maybe even 30 years in amortization, meaning that your payment can now be reduced. There's a caveat to that. You're like, well, that sounds really good. What's the catch? I'll tell you. When you do an FHA loan on the residential side, there's 1 3/4% upfront mortgage insurance. Okay? So that's a fee that goes right into the loan, and you have mortgage insurance forever. Now, that's only through FHA. I'm going to translate that to SBA. In SBA, there is 2 3/4% fee, plus minus, for the amount of money that you borrow. So it's in your vested interest not to borrow the whole thing if you can from SBA, but only borrow, say, the 40% and then get the 50% from the bank, because there's no fee, there's no guarantee fee. The guarantee fee on the 40% is in case you default and they got to take the property back. Because remember, we talked risk a minute ago, right? When I told you 50% for the bank is not a lot of risk. Another 40% for them in second position behind the bank, that is a lot of risk. This video is about 100% financing. How do I push myself to 100%? This is a good question. Let me answer. So right now we're financing approximately 90%. The bank is 50, CDC is 40. You can get working capital up to 100%. So things that you need for your business to be able to operate, to buy machinery, equipment, different things, furniture, a bunch of things that are going to be designed for you to be able to open your doors as working capital, or maybe enhance the business from where it is now to where you want to get. And this is how you could actually get 100% financing for your owner-occupied transaction. It's a lot of information, guys. I live for comments in the notes. So please, this one is a challenging one. If you have questions about it, please put it in the notes so I can answer it. I would love to see the feedback. Hopefully I'm conveying this in a way that you guys are understanding, that's clear. I'm trying to make it as simple as possible. In addition to it, two things. Number one, in the links below, if you're inquiring about a lending scenario, there should be a link below where you can, present that scenario and get some answers for it. Number two, there's a course in the link below if you want to get involved in this type of knowledge, lending knowledge, kind of get on the path of doing this. I'm presenting a new course. It's actually a pre-order at the moment, and the link is gonna be in the descriptions below. I really hope you guys enjoyed this video. Again, I live for the comments. Make sure thumbs up, subscribe, comment. Let me know what you think, and hopefully I will see you guys on the next video. Thank you for watching. Take care.